Welcome to a world where finance and investment are not just terms but a way of life. Today, we delve into the intriguing arena of SPY versus VOO ETF. Let's kick things off by demystifying the acronym ETF. It stands for Exchange Traded Fund. Picture this, a basket filled with different types of financial instruments. We're talking stocks, bonds, commodities. That's essentially what an ETF is, a basket of diversified assets that you can buy or sell on a stock exchange, just like a single stock. But why would you want to invest in a basket of assets instead of choosing individual stocks or bonds? Well, the answer lies in the magic word, diversification. When you invest in an ETF, you spread your investment across a broader range of assets, reducing the risk associated with putting all your eggs in one basket. ETFs are also a popular choice due to their flexibility. You can purchase and sell shares in an ETF throughout the trading day just like you would with an individual stock. This gives you the ability to react quickly to market changes. Moreover, ETFs are known for their transparency. Most ETFs disclose their holdings on a daily basis, which means you can see exactly what assets you own through the ETF. This level of transparency can provide a greater sense of control and confidence in your investment decisions. And let's not forget about the cost efficiency factor. ETFs typically have lower expense ratios compared to other investment options like mutual funds. This means more of your money goes towards your investment and less towards fees. So, to sum it up, ETFs offer a unique blend of diversification, flexibility, transparency, and cost efficiency, making them an appealing choice for many investors. Now that we have a basic understanding of what an ETF is and why it's a popular investment choice, it's time to introduce the stars of our show, the SPY and VOO ETFs. With that basic understanding of ETFs, let's explore the stars of today's show, the SPY and VOO ETFs. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. The SPY ETF, officially known as the Spider S&P 500 ETF Trust, is a behemoth in the ETF world. It's like a Goliath, towering over many of its counterparts. And as we dive into the heart of this financial titan, you'll see why it's earned such a lofty status. First, let's talk about what makes the SPY ETF tick, its structure. The SPY ETF is structured as a unit investment trust. Now, I hear you asking, what on earth is that? Well, in simplest terms, a unit investment trust, or UIT, is a type of investment company that buys and holds a fixed portfolio of stocks, bonds, or other securities. One of the most appealing aspects of SPY's UIT structure is that it's designed to closely track the performance of the S&P 500 index. So, when you invest in SPY, you're essentially investing in 500 of the largest US companies. And that's quite the diversified portfolio, wouldn't you agree? Now let's talk about SPY's holdings. As we've mentioned, SPY holds the same stocks as those listed in the S&P 500 index. This means it's packed with big names like Microsoft, Apple, Amazon, and Facebook. Yes, you heard it right. When you invest in SPY, you're rubbing shoulders with the likes of these corporate giants. But what about its performance? Well, since its inception back in 1993, SPY has consistently delivered solid returns. It's weathered economic storms, ridden market highs, and navigated financial crises, all while providing investors with a steady stream of income through its dividends. Of course, past performance doesn't predict future results, but there's something to be said about SPY's resilience and its ability to mirror the broader market's performance over the long term. It's like the steady ship in the ever-changing sea of the financial market. SPY is also incredibly liquid. This means you can buy and sell shares of SPY with ease, making it a favorite among both individual investors and institutional investors. It's like the popular kid in school everyone wants to befriend. Lastly, let's touch on SPY's expense ratio. With an expense ratio of 0.0945%, SPY is cost-effective for investors looking for broad market exposure. While there are other ETFs with lower expense ratios, SPY's liquidity and its track record of solid performance often make it a compelling choice for many investors. The SPY ETF, with its broad exposure and solid performance, has become a staple in many investors' portfolios. It's like the trusty old friend you can rely on, the rock in the turbulent sea of investing. Whether you're a seasoned investor or just starting out, the SPY ETF is worthy of your consideration. Now, let's switch gears and look at another heavyweight in the ETF arena, The Vanguard S&P 500 ETF, also known as VOO. The Vanguard S&P 500 ETF, or VEO, is one of the largest and most popular exchange-traded funds on the market. It's managed by Vanguard, a company well known for its low-cost index funds and ETFs. VOO is designed to track the S&P 500 index, which comprises 500 of the largest U.S. companies. So when you invest in VOO, you're essentially buying a tiny piece of each of these companies in one fell swoop. VOO's structure is simple and straightforward. It's a passively managed fund, which means it aims to mimic the performance of the S&P 500 rather than trying to outperform it. This passive management style helps keep costs low, making VOO a cost-effective choice for investors seeking broad market exposure. The ETF's holdings are diverse, spanning across various sectors and industries. The top holdings typically include juggernauts like Apple, Microsoft, Amazon, and Facebook, companies that play a substantial role in the U.S. economy. This diversification can help smooth out the bumps in the road when individual sectors or companies face challenges. When it comes to performance, VOO has a strong track record. Since its inception in September 2010, it has closely mirrored the performance of the S&P 500. In fact, VOO's annual average returns have typically been within a hair's breadth of the index it tracks. This consistency is one of the appealing aspects of VOO, offering investors a reliable way to participate in the broad U.S. stock market's growth. Moreover, VOO has a lower expense ratio than many other ETFs. The expense ratio is the annual fee that all funds or ETFs charge their shareholders. It represents a percentage of your investment that goes towards the fund's operating expenses. For VOO, this ratio is just 3 basis points or 0.03%. Making it an incredibly cost-effective choice for investors. It's also worth noting that VOO offers a decent yield. This yield comes from the dividends paid by the companies in the S&P 500, which are then passed on to VOO shareholders. If you're an investor who appreciates a steady income stream in addition to potential capital gains, VOO's dividend yield could be a compelling feature. In conclusion, VOO is a solid choice for investors seeking broad exposure to the U.S. stock market. Its low costs, diverse holdings, and track record of consistent performance make it an attractive option for both novice and experienced investors. VOO has certainly made its mark in the ETF world, offering investors another solid option for S&P 500 exposure. Now that we've introduced our two contenders, it's time for a head-to-head comparison: SPY versus VOO. When it comes to ETFs, it's all about the details. Every investor has their unique set of priorities. Let's dive into the nitty-gritty of these two funds based on several key factors, starting with expense ratios. Expense ratios are essentially the operational costs of running an ETF, expressed as a percentage of the fund's total assets. They're the small, often overlooked fees that can eat into your returns over time. The SPY ETF, being the oldest and most established fund, has an expense ratio of 0.09%. On the other hand, VOO, managed by Vanguard, prides itself on its low-cost index funds and sports an even lower expense ratio of 0.03%. That's a third of what SPY charges. While the difference may seem minuscule over the course of 10, 20, or 30 years, it can add up to a significant sum. Now let's talk about liquidity. In the world of ETFs, liquidity refers to how quickly and easily shares can be bought or sold without impacting the price. SPY, being the first ever ETF and the most traded security in the world, boasts unparalleled liquidity. With an average daily volume in the hundreds of millions, you'll rarely struggle to find a buyer or seller. VOO, while not as heavily traded, still offers excellent liquidity with daily volumes often exceeding tens of millions. For most investors, both funds offer ample liquidity to execute trades efficiently. Next up is tracking error. This refers to how closely an ETF follows its benchmark index. Both SPY and VOO track the S&P 500, but they do it with varying degrees of precision. SPY has a slightly higher tracking error due to its structure as a unit investment trust, which limits its ability to reinvest dividends immediately. VOO, on the other hand, as an open-ended fund, can reinvest dividends as soon as they're received, resulting in a lower tracking error. Lastly, let's look at total returns. Remember, past performance is not indicative of future results, but it can provide some insight. Over the past decade, both funds have delivered impressive returns, closely mirroring the performance of the S&P 500. However, when we factor in VOO's lower expense ratio, it has slightly outperformed SPY by a narrow margin. Again, this is not a guarantee of future performance, but it's worth noting. So, to recap, SPY, the granddaddy of all ETFs, offers unmatched liquidity and the comfort of a long-standing, reputable fund. VOO, while younger, offers lower expenses, a lower tracking error, and slightly higher returns. Both are excellent choices for investors looking to gain exposure to the S&P 500. But remember, investing is not a one-size-fits-all endeavor. What works best for you depends on your specific financial goals, risk tolerance, and investment horizon. As you can see, while SPY and VOO are similar in many ways, they each have their unique strengths and weaknesses. The key is to understand these differences and make an informed decision based on your individual needs and circumstances. Happy investing! The million-dollar question, which is better, SPY or VOO? Let's dive right into it. So, you've gotten a good look at both SPY and VOO. You've seen their structures, their expense ratios, their holdings, and their performance over time. Now, it's time to decide which one is a more suitable fit for your investment portfolio. Each of these ETFs has its own unique strengths and characteristics that make it appealing to different types of investors. Let's begin with SPY. The Spider S&P 500 ETF, or SPY, is the oldest and most traded ETF in the world. It's known for its liquidity, meaning it's easy to buy and sell shares, which can be a major advantage for day traders or those who value flexibility. It's also been around for a long time, which means it has a proven track record of mirroring the performance of the S&P 500. But what about its expense ratio? At 0.095%, it's definitely higher than VOO's. But remember, an expense ratio isn't the only factor to consider when choosing an ETF. Some investors might be willing to pay a slightly higher fee for the benefits that come with SPY's liquidity and long history. Now let's switch gears and talk about VOO. The Vanguard S&P 500 ETF, or VOO, has a lower expense ratio than SPY, sitting at 0.03%. For long-term investors, this lower fee can make a significant difference in returns over time. In addition, VOO is known for its strong track record of closely tracking the performance of the S&P 500, just like SPY. But there's a key difference. Because VOO isn't as heavily traded as SPY, it might not be as suitable for day traders or those who need high liquidity. However, for buy-and-hold investors who are looking for a cost-effective way to invest in the S&P 500, VOO might be the better choice. So, who wins the battle between SPY and VOO? Well, there's no definitive answer. It truly depends on what you're looking for in an ETF. If you're a day trader or someone who values high liquidity, SPY's high trading volume could make it the better choice for you. On the other hand, if you're a long-term buy-and-hold investor who's more concerned about keeping costs low, VOO's lower expense ratio could make it the more attractive option. Remember, it's not just about choosing the ETF with the lowest costs or the highest liquidity. It's about choosing the ETF that aligns with your investment goals and strategy. In conclusion, both SPY and VOO are excellent choices if you're looking to invest in the S&P 500. They both have their own unique advantages and trade-offs. It's up to you to weigh these factors and decide which one is the best fit for your portfolio. Ultimately, the choice between SPY and VOO comes down to your personal investment goals and preferences. And that, dear viewers, is a wrap on our discussion about SPY versus VOO ETFs. We've traveled quite a distance together, unraveling the intricacies of these two powerhouses in the world of exchange-traded funds. We've taken a deep dive into the SPY ETF, understanding its roots, its structure, and its performance. We've done the same for VOO, shedding light on its inception, its unique composition, and its track record. Remember, we started our journey by introducing ETFs, their purpose, and their role in diversifying your investment portfolio. We then put the spotlight on SPY, the world's first ETF and a behemoth in the S&P 500 index tracking space. In its nearly 3 decades of existence, it's proven its resilience and reliability, consistently delivering returns that mirror the broader market's performance. Next, we ventured into the world of VOO, a younger yet equally formidable player in the ETF arena. Despite its relatively recent arrival, VOO has quickly gained a reputation for its low expense ratio and its faithful tracking of the S&P 500 index. The heart of our discussion, of course, was the comparative analysis of these two ETFs. We dug into their similarities, their differences, and the unique value propositions each brings to the table. We examined their expense ratios, their liquidity, and their historical performance, providing you with a comprehensive picture to help inform your investment decisions. But as we emphasized, there's no definitive answer to which ETF is better. The better ETF truly depends on your individual circumstances, your investment goals, your risk tolerance, and your time horizon. What's important is that you're armed with the knowledge and insights to make an informed decision that aligns with your financial aspirations. And that's our mission, to empower you with the information and understanding you need to navigate the complex landscape of investing, to help you sift through the noise and focus on what truly matters. But our journey doesn't end here. There's a whole universe of investment opportunities out there waiting to be explored, and we're here to guide you every step of the way. We'll continue to bring you in-depth analyses, insightful discussions, and expert perspectives on a wide range of investment topics. So, if you're ready to continue this journey with us, we invite you to join our community. Remember, investing is a journey, not a destination. If you found this video helpful, do us a favor and hit that subscribe button, give us a like, and share this video with your fellow investors. Until next time, keep investing and keep growing.